Welcome to renovatED, where we talk about all things home and renovation related. Hosted by Jennifer the Reno Gal Goldsby, a renovation lending expert. Let's get renovated. I hope you enjoy this bonus episode of renovatED. Ironically, it doesn't have a whole lot to do with renovations, but it does have to do with refinancing. I work in the mortgage world, and traditional loans, including refinances, are just a part of my day-to-day world. So I wanted to chat with you guys about some things that are going on behind the scenes in the mortgage industry and what to expect when interest rates decline. For quite a while now, we've been hearing that interest rates are going to come down. They're going to come down. They're going to come down. But they haven't come down yet. We continue to hear that rhetoric, and eventually the rates will drop. By how much is anyone's guess. But at some point, interest rates will come down, and when they do, you are going to get barraged by lenders, encouraging you to refinance your mortgage. I want you to be aware of the factors that are driving many lenders to push refinancing aggressively. They have been practicing. They have their scripts. They have done their training. For over 3.5 years, rates have gone higher and higher and reduced both purchase and refinance activity. That has left many lenders with lowered loan origination volumes. In response, for those especially who are just hanging on by a thread, but quite frankly, for any lender in the mortgage industry, there are going to be those who train their loan officers to very aggressively create a sense of urgency around refinancing, oftentimes using high-pressure scripts to persuade homeowners to act now. I think there are some things that you need to know to make an informed decision about refinancing. You may encounter loan officers who highlight supposed benefits, such as skipping 1 or 2 months mortgage payments as a reason to refinance. While that can sound appealing, that is rarely a compelling reason to refinance. In fact, it may not even result in real cost savings. For example, in the cases of a streamlined refinance, which a lot of lenders are going to tout, homeowners might need to bring cash to the closing table, negating any perceived advantage of skipping a payment. Always question claims that sound too good to be true, and remember, refinancing is not just about short-term perks, but about long-term financial benefits. There are some legitimate reasons to refinance. It can be a smart financial move if it's approached for the right reasons. I'm sure these are not going to be exhaustive, but we'll talk about a few where refinancing might make sense. I'll give you 9 examples of when you might consider to refinance. Number 1, combining multiple mortgages. If you're trying to simplify your finances by merging 2 or more loans into one with a potentially lower combined interest rate, that is a great reason to refinance. It saves you money. It makes it easier to make your payments. Win-win. Just be careful of any closing costs that are attached. And that's really going to be true anytime you refinance. You want to take a look at those closing costs and make sure they're not too high, negating any potential savings. Number 2, consolidating a first mortgage and a home equity line of credit. If you're transitioning from interest-only payments and you've not been disciplined enough to make principal payments on your home equity line of credit or your HELOC to pay down that principal, then consolidating a first mortgage and a HELOC makes a lot of sense and can create some long-term savings. Number 3, paying off mortgage debt faster. If you're refinancing to shorten your loan term so you can pay your debt off early and save on overall interest, it's a great reason to refinance. Number 4, lowering monthly payments. Sometimes long-term savings aren't the only benefit. If you get in a pinch and you find yourself getting deeper and deeper into other debt each month, maybe it makes sense to extend your loan term to reduce your monthly mortgage payment and improve cash flow. Number 5, reducing interest rates. Take advantage of lower rates when they come down to decrease the costs of your mortgage. But again, as with any refinance, you want to make sure that you are factoring in the closing costs and you're looking for that break-even point. There's going to be one. And if your loan officer can't calculate your break-even point and tell you how long it's going to take to recoup the closing costs that you are adding into your new mortgage, you need to find yourself a new loan officer. Number 6, consolidating debt. You can roll high interest debts into your mortgage if you do a cash out refinance to save on overall interest potentially reducing monthly expenses and long-term costs. That makes sense if you are consolidating high interest rate credit card debt, for example, but there could be other examples as well. Number 7, switching loan types. If you're converting from an adjustable rate mortgage to a fixed rate mortgage for stability, that could be a wonderful reason to refinance. Number 8, eliminating mortgage insurance. If you're refinancing to remove private mortgage insurance or PMI on conventional loans, if you've gained sufficient equity prior to that 2-year mark, that 2-year mark, by the way, could enable you to manually request PMI removal without having to refinance. But let's say we're within 2 years, you've gained equity. This is really common when you've used a renovation loan, for example, to purchase a property and renovate it. And in doing so, you've gained some equity. So instead of waiting the full 2 years to wait until you qualify to manually request a PMI removal, you go ahead and refinance to get out of PMI. And if you can do that while simultaneously lowering your interest rate, even better. If you're in a government loan and you're looking to refinance to completely remove or eliminate mortgage insurance premiums, that's called MIP on government-backed loans, that could be another good reason to refinance. And lastly, number 9, leveraging equity for major expenses. If you're going to take advantage of lower interest rate options to utilize your home equity for, let's just say, higher education costs, or maybe you're going to take some cash out of your home and you're going to invest it in something that gives you a much higher return on your investments, or possibly you're going to do a cash out refinance to do some home improvements. Those are all things that make sense, that can justify a refinance. Again, I want to emphasize the importance of calculating that break-even point. Before you refinance, before you go to closing, it's crucial to understand when you will break even. It's going to take time to recoup the costs of refinancing. Unless your lender is offering you a no closing cost option, you're going to incur closing costs. A qualified and experienced loan officer can certainly help you calculate this. And knowing that break-even point can ensure that you're evaluating whether refinancing aligns with your long-term financial goals, especially if you're considering selling your home in the near future or if you're making a rash decision. Let's touch on that just for a second here. Let's say you're considering selling your home. You know you're going to sell your home within 1-2 years. If your break-even point isn't until year 3, year 4, it would not make sense for you to refinance even if the interest rate is lower. So if your loan officer cannot calculate that break-even point for you, it's time to move on and find one who can. Let me share with you some overall steps to improve your financial health. If you decide to refinance, there are some strategies that you can execute to maximize financial benefits. You're going to end up with a higher loan amount if you're rolling in your closing costs. That's just, it's just part of the game. But there are some things that you can do to offset that higher loan amount to try to get it back down as low as it's possible to your original principal balance that remained on the loan before you refinanced it. One of those things that you can do is you can take your escrow balance from your current mortgage lender. Sometimes they'll take it out of your payoff amount. So let's say you owe $200,000 on your house and you've got $3,000 in your escrow account for taxes and insurance. Sometimes what they'll do is they'll just send your new lender a payoff amount for $197 and call it a day, which is great if they do that. There are some cases where an escrow balance isn't reduced from your payoff. And in those cases, you'll typically get reimbursed by your old lender probably within about 30 days after you've paid them off. So once you get that check, don't spend it, but apply it as a principal reduction to your new loan, and that'll help bring that loan amount down a little closer to what it was before you refinance. Another thing that you can do is apply any perceived missed payments to your principal balance. Some loan officers will sell you on the fact that you'll miss 1 or 2 monthly mortgage payments, and that's fine and it's true. But instead of viewing those as skipped payments altogether, save that money, put it aside, and once your loan closes, you can apply those funds toward the new loan's principal to reduce that loan balance that you owe. I've said it a couple of times in this podcast. I'm going to end on this note. You want to consult a qualified loan officer. Refinancing is not a one-size-fits-all solution. Only trustworthy loan officers can help you weigh the pros and cons, making sure that you're not lured into refinancing without a clear understanding of the financial implications. So look for somebody who's experienced, who's professional, and who's prioritizing your financial health over their sales quotas. Bottom line, Refinancing can be a powerful tool for improving your financial situation, but only when done right for the right reasons and with the right guidance. Now, the legalese required to appease attorneys, compliance officers, and regulators. This podcast is hosted by Jennifer Goldsby, NMLS 591226, VP Renovation Lending. The topics discussed herein reflect my personal opinion. They do not represent the opinions of Diamond Residential Mortgage Corporation and its management. Discussions about loan programs in this podcast are not a commitment to make a loan. Programs, approvals, rates, fees, and loan terms are subject to loan applications, credit risk, appraisal evaluation, underwriting guidelines, and other lending or qualification criteria and limitations, and are subject to change without notice. Not all products are available in all states. Not all borrowers will qualify. Diamond Residential Mortgage Corporation, 582 Oakwood Avenue, Forest 60045, 847-244-9301. NMLS 186805. For licensing information, go to nmlsconsumerAccess.org/entity details.aspx/company/186805 Equal Housing Opportunity. Diamond Residential Mortgage Corporation is not affiliated with or acting on behalf of or at the direction of FHA, VA, USDA, Fannie Mae, Freddie Mac, or any governmental body or agency.